Hello, Maverick traders. Nice to see you. This is Robb Reinhold, and we are here to discuss probably my all-time favorite option strategy, the call and the put ratio backspread. Now, let me say this. When I learned about this strategy, and I placed this trade a couple times, I thought that I had literally found the holy grail of trading. Now, in full disclosure, I've probably thought that 5 or 6 times in my career where I've stumbled across something and it was amazing. And when I tried it, it worked and it worked. And it was like, oh my gosh, I did it. I did it. All I need to do is this one thing. And I don't need to do anything else. If I just do this one thing all the time, it's going to make it to where my trading is always profitable. Well, I hate to break it to you. That does not exist. That does not exist. And everything I found that was the so-called holy grail, it stopped working in some certain market environments and actually became the worst trade I could make. And that's really the problem with people that have singular strategies, is if you just have one strategy, that strategy is going to work well in a certain market environment. And in another market environment, it's going to do terrible. One of the most popular strategies over the last 5 years has been selling calls and selling puts, mostly selling puts. Now, selling puts, if you just sell a put, let me give you a quick run through of selling puts. So if you sell puts, there is let's say there's a stock at 50 and you sell the $50 put for $3. You get that $3 in, and as long as the stock doesn't close below 50, you get to keep that $3 and nothing happens. If it does go down, you actually have to buy the stock at 50, so your break even on this is at 47. So what people have been doing is saying, look, I'm going to do this on stocks I want to own. I'm okay if I do get the stock put to me because then I'll just own it. Okay, well look, this was great and this worked great for the last 5 years, but how well do you think the strategy worked in 2007 and 2008 and the beginning of 2009? Anyone who used this got slaughtered and they got put out of the game. It's because they thought that one strategy can work all the time. Here's another one that's very, very popular. Let me do a very wide condor on the S&P. And let me do it so wide that I'll bring in 50 cents, but then I'll risk 450. But it's so wide that I have a 98% probability. So people think, oh, this is a no-brainer. This is another very popular strategy lately. Well, in the first part of 2018, anyone doing this got slaughtered, and they pretty much lost all their money. There is a famous story about a lady called Karen the Super Trader. Now, Karen was really highlighted by Tasty Trades and TD Ameritrade as this is the strategy that you can use. Well, she's actually under SEC investigation not because of her losses, but because she hid the losses from her investors, and she just went into a scheme where she rolled ahead to further months out to where she never had to take the realized loss, and so she never reported it. Anyway, I'm getting off topic here. Our topic here is call and put ratio spreads, but I wanted to go over this because when I found this out, I thought this is the greatest thing, and when I went out and tried it, it worked, and I was like, all I need to do is do this every single time earnings come around, and I'm going to be a multimillionaire in a couple years. Turns out it doesn't work all the time, and there's some market environments where it works well and some where it doesn't work well. So that's really what I wanted to go through today is, the strategy's out there. We teach the strategy in our directional options session. We go through how it works. This is where, again, it's like college. You go to class, you learn how business should work, and then once you go into business, you find out, oh, it's not really all that cut and dry. There's some things that the professor didn't tell me about. This is what we're going to get into today, is really the nuts and bolts of making the trade. All right, well, let's quickly go through, just make sure everyone has the strategy. We're going to talk about call ratio backspreads here. Of course, put ratio backspreads are just going to be the same thing in reverse. So this is a +3 or a -3 strategy. There is no reason at all to use this strategy if you think that something's going to go up a little bit, or if it's just going to go up moderately. This needs to be on something that you think is going to be so much upside or so much downside that you're willing to take a very, very aggressive stance on it. So again, you've got to be +3, -3, or else don't even pull this out. So that right there is going to really dictate when you can use this strategy. If you are in a period of time where the market, where earnings are coming out and stocks aren't moving all that much, this is not the time to pull out a +3 or -3 strategy. It's not. Things are in a tight range. This is not the time to pull out this strategy. This is where, again, you have a very reasonable expectation that there's going to be a very large move one way or the other, and you want to make an aggressive play for that. I make this kind of trade a couple times a year, where I call it stick my neck out, to where I try to really capture a big move. So this is really best suited for announcements, and let me tell you why. This trade needs more movement than the market expects. So if you've gone to any of our sessions on the straddles and the strangles, we talk about how the straddle is simply the over-under bet in sports betting. For those of you, again, that don't know, the over and under bet is, okay, well, how many points are the two teams combined going to score? Now, it's not who's going to win or lose. It's not the bet. The bet is it going to be more points than we expect or less points than we expect? So the straddle is a bet on, okay, we know it's going to move. The market expects it to move this much. Do we think it's going to be bigger than the market expects or less than the market expects? That's the straddle and strangle bet, that it moves more. A butterfly would be, hey, I think it's going to move less. So this is actually more aggressive than that. This is okay. I think the market is priced in that it's going to move this much. I think it's going to move way more. Now, this is the risk graph on it. And you can see that the way it works is this is basically a straddle. So if we were to do a straddle at 52.50, this would be our risk graph. Now, of course, the slope would be a little bit different. But you can see what we're doing is we are saying we will cut off our profit potential on this side to get a steeper line on this side. So let me redraw that because I think I could do a better job. If you were to look at a straddle, this would be the straddle. Let me try to draw some straight lines here. And what you're saying is, okay, I'm willing to chop off all this profit potential down here, but I want to have a steeper line on the other side. And that's the bet. Your bet is, I think it's going to have a much bigger move up. And I'm willing, instead of doing the straddle, where I bet on both sides, I'm going to load it all on one side. So if you can see on the risk graph, the worst thing that can happen is it goes nowhere. If it does go down, and you're in a call ratio backspread, you could potentially make a small profit. That's not really what we're going for. We're not going for a small profit here. What we're saying is we want this. We want this really steep line to where if this stock jumps all the way up to $75, it is going to be just a huge gain. A huge gain for the amount of risk we're willing to take. Again, this is really a play on, I'm going to put out some risk, and if it has a big, big move, I'm going to have a substantial reward. And again, a big reward. Alright, so again, that's really the strategy. It's a straddle where you've cut off one of the legs and you say, okay, well, I'm going to give up my profit if it has a big fall to get a steeper line on my call side. Alright, so that is a call ratio backspread. Again, we're going to get break-evens. We're going to get break-even points. These are the points we need to know about on the chart. We're going to need to know our max risk. We're going to need to know, okay, how much are we going to make on this side? And of course, this side is going to be unlimited. These are all the things we need to do to put together a proper trade, because we really need to know these break-even points, because this is where your chart is going to come into play. Are these break-even points likely to break? Because if it's likely to stay in between 48 and 57, it's not worth making the trade. This is the wrong trade. The wrong trade totally. There's different trades we can make for this. So we need to know where these break-even points so we can take a look at a chart and analyze them. All right, real quickly here, I'm going to go through the put ratio backspread, which is simply the same thing. Now again, we're going to be selling less than we're buying. So again, that's why it's called a ratio spread, is that we are not going to be buying and selling the same amount of contracts. It's going to be a ratio spread. Now it is going to be the same month. So again, this is going to be like a vertical spread with extra calls or extra puts. I'm going to talk about that here in a second when we talk about execution. But it's the same thing. We've got our break-even points, and we want to just make sure we know where those points are. We need to know what our max risk is. And again, we need to know all these numbers so when we go into the charts and we go into our position sizing, we can build the right amount of trades. All right, now let's talk about the reality of it. So we just talked about the strategy, and again, I didn't go through the strategy in great detail because we have a session that goes through the strategy in great detail. So you should have already seen that. This is about, okay, let's take the theory of what you learned in your classroom and let's go out into real life and really see how it works. Now this is the big deal with both the straddle, the strangle, and the call ratio and put ratio backspreads, is the volatility crush. The volatility crush is going to be a big deal with this. Alright, so the volatility crush, we've got sessions on this as well if you want more information about what the volatility crush is, how it works, how to measure it. It's basically saying that implied volatility is going to be at the highest level right before a known major news announcement. Now this makes sense. Implied volatility is the market's bet on how much the trade or the stock is going to move. Now obviously if this is a low volatility stock and there's no news on the horizon, then the odds of there being a big unsuspected move are going to be quite low. However, if it's a high volatility stock that has an earnings report coming up in the next week, well, that's going to get priced into the options. That's going to get priced in the options where there's going to be more volatility. And it's actually pretty cool. You can actually look at a volatility chain. And let's say that, again, I'm going to use week 1 options. And then we're going to take a look at week 2 options. So let's say that we're looking at an options chain. And the stock has earnings during week 1. So let's say that on Thursday of this week, the stock has earnings. If you take a look at implied volatility on those options, it's going to be very high. It's going to be, 48%. If you take a look at on subsequent ones, sorry, let's move this down. You're going to see that there's less volatility. I screwed that up. Imagine this is on week 2. You're going to see implied volatility is much higher on this option because during this option there is a news report. This option will have expired already. There's going to be no news during it. So you're going to see the implied volatility is much higher if that option has an earnings date in it. That's just how it works. So go out there, check it out. It's actually pretty cool to see. So traditionally speaking, again, this is of course not a hard and fast rule. This is what it's like most of the time. If you were to chart and track implied volatility usually peaks the morning before an announcement after the bell. So let's say that IBM announces earnings after the bell today. We would see the peak in implied volatility, again, if we looked at it over days and days and days, so let's say 3 weeks out from its earnings report, we see implied volatility start to build. And again, this is the earnings date. What we're going to see is we're going to see it peak out a little bit before the report, and then it kind of just tapers off. It doesn't come down much, but we typically see the highest point of implied volatility the morning before. Now, if the earnings are before the bell, we usually see it climb all the way into the close. Again, this is just how it is. Do not get too caught up in this. This is a very small amount. We're talking about 1 to 2% of implied volatility, which is not going to change your trade whatsoever. But just wanted to let everyone know that's kind of what generally happens. So what happens is there's this build and build and build of implied volatility. Something big is going to happen. Everyone's placing their bets. Everyone knows an earnings report is coming out or a major announcement, so they're placing their bets. Once that news comes out, that implied volatility comes out, regardless of what happens. Regardless of what happens. Even if there is a huge move downward. So let's say there was a stock that was at 50 and it drops down to 30. Now traditionally, if this just happened and it wasn't priced in, what would happen in this situation was implied volatility would go up. Implied volatility would actually go higher because this move was not expected. And so when it happens, implied volatility goes higher. And plus, we know that implied volatility usually goes higher when stocks go down and lower when stocks go up. So we generally would see a move higher in implied volatility. The problem is, if implied volatility had already been building ahead of this announcement, even though there was a big move, that implied volatility is still going to drop. Now, it's not going to drop as much on a down move as it will if this stock runs up to 70. Hopefully everyone understands why, because again, implied volatility is really tied to fear. So when a stock drops from 50 to 30, there's a lot of fear. Implied volatility moves higher. When a stock jumps up to 70, there's really not any fear. We get volatility that comes off a little bit more. So always tie fear and implied volatility together. It's a good way to understand how it moves. So you're going to get a volatility crush. Even if the stock drops, we're still going to see volatility come out of it. Now let's talk about what to expect. Now again, these are going to be general rules. I wish I could give you hard and fast rules about implied volatility. And I've always said that, you can really plot everything out. Like I can plot out exactly how delta is going to move. I can plot out exactly how gamma is going to move. I can plot out exactly how theta is going to move if the stock drops $20. All of that is linear. It's all a math formula. It's very easy to do. The problem is implied volatility is not a formula. Implied volatility is the wild card. It's the wild card. You really don't know how implied volatility is going to change. And that's really the wild card behind all options trading is implied volatility. So I'm going to throw out a couple just rules of thumb that I use. So if you are short term, and again, this is to when the option expires. So if I'm looking at a trade on Wednesday and I choose Friday's options, so the weekly options, and it has an earnings report on Thursday, I should expect almost all of the volatility to come out of it. Hopefully that makes sense. Because at the end, when an option expires, volatility is always at zero. That's how it works. Volatility goes to zero at expiration. So if you're 2 to 3 days out and you get that volatility crush, you should expect to see 80% of that volatility come out. So again, you can take a look and see what is how much of this option premium is implied volatility. That's what you're going to see come out of the option immediately. If you're 1 to 2 weeks out, so again, let's say today is Wednesday, and let's say I'm looking for an option that's 2.5 weeks out, and I buy it today, and there's an earnings report tomorrow. Hopefully that makes sense. So I'm still buying the option before the earnings report, but the option doesn't expire for 2.5 weeks. There's going to be a volatility crush. I should expect to lose about 50% of the volatility. Of course, it could be less than that, it could be more than that, but this is just rules of thumb. And then next, if you're even further out than that, you should expect a smaller drop. So hopefully everyone sees that the closer you are to expiration, again, remember, implied volatility goes to 0 at expiration. So you should expect, if you only have 2 days on the trade, you should expect you're going to lose most of the implied volatility. If you're a couple weeks out, you're probably going to lose about 40 to 50%. And again, we're going to go into the options pricing calculator. We're actually going to see all these numbers. We're going to look at it, and that's what I really want this to be about, is for you to go in and actually look at all the numbers and really build your trades. If you're further out, again, you would expect less of a drop in volatility because there's still much more time. Okay, so again, what I want to do is I just want to get kind of everyone set up for what we're going to do. We're going to go out and we're going to build a trade. We're going to take a look at the break-even points. We're going to take a look at the volatility crush. We're going to say, okay, let's say worst case scenario, the stock doesn't go anywhere after earnings. What would we expect to lose on the trade based on the volatility crush? So again, I want to make sure everyone knows their profit points. I want to make sure everyone knows how to calculate their risk points. And the last thing I want to do is I want to make sure everyone understands how to execute the order, how to get into the trade. All right, well, let's talk about the different ways that you can execute this trade. Now, you can enter this as an entire combo. So again, we'll go into Thinkorswim, and I'll build it as a combo, whereas we actually put everything together. So you basically say, look, I want to be 3 long and 1 short. So again, I'm just going to take, let's take the 70-80 call ratio backspread. So we're short 1 of these and we're long 3 of these. That would be the ratio here. So you would literally build a combo that follows this. That, okay, I want to sell 1 of the 70s and I want to buy 3 of the 80s. And then, of course, you're going to get the bid and the ask. And the bid and the ask is going to be something like, 25 cents by $1.75. Now, I actually wrote it like that on purpose because if you enter the entire trade as a combo, you're going to be combating some pretty wide spreads. Remember, you've got a few things working against you. Number one, you're typically selling a pretty deep in-the-money option. So again, let's say the current price of this stock is $78. If you're going all the way down to the $70 call, there's not a lot of volume on this option. And whenever there's not a lot of volume on something, you get wider spreads. So the spread on this might be 770 by 830. So you have a 60-cent spread right there. And then of course, on the 80s, you might have something like a $2 by 220. But you've got 3 of these, so that's another 60 cents. So you have 60 cents on the -1, you've got 60 cents on the +3. Now you've got a $1.20 spread that you have to figure out how to manage and how to cut that down. Now, of course, we always try to shoot for the midpoint. So the midpoint on this one would be $1. We could try to go out and get filled on this for $1. That would be the midpoint of what we're shooting for. Now, of course, the more legs you have in a trade, the more difficult it is to get filled as a combo. That's just how it is. If you've got a 4-leg combo, realize it's going to be much harder to fill that all at once than just a single option. You've got to navigate 4 different legs here. So you can enter as an entire combo, which we'll take a look at that. Or you can enter it as leg by leg. All right, so if you enter this leg by leg, let's go back to we're going to be long 3 contracts of the 80 calls, and we're going to be -1 short of the 70s. So we would go out and we would actually go out and place this order. And the spread was $2 by 220. So what we would do is we'd go out and we'd just put in a single order for 3 contracts. We'd cut this down to 210. We'd try to get filled at 210. Once we get those filled, we then go do the short leg. You always want to enter the long legs first because you don't want to end up being naked. And again, let's say that this one is 780. I think we put 770, that's right, 8 by 820. So again, you're going to go into the midpoint. Let's try to get filled at 8. And again, you're just trying to get filled on one short. And let's say that gets filled. So at this point, you have plus $800. You sold one contract for $8. But then you bought 3 contracts at $210. So if you bring in $800 and you spend $630 of it, you end up with $1.70 of credit. That's going to be your credit on the trade. Now, whatever the credit is always the amount that you are going to make on the bottom if the stock goes the other way. So if we were to price this out and we entered this trade, the risk graph over here would be $1.70. This is how much we would make if it goes below the short strike price. It's the credit. It's whatever we end up in the credit. Now look, if we did a 4-to-1 ratio where we bought 4 of these, we would end up spending $8.40. If we spent $8.40 but only brought in $8, we were actually negative 40 cents. So this risk graph would actually be under. And we would have a 40-cent loss if the thing really crashed. Now, of course, why do you want to do that? Well, you get a better ratio. You are going to steepen this line quite a bit. The more longs you can buy compared to the shorts, the steeper this line gets on the bullish side. So there's definitely been times where I've made trades where I fully know that if it goes the other way, I'm still going to take a small loss. But I'm okay with that because I get my extra leg. I get my extra leg to make it a little bit more bullish. So again, that's entering it leg by leg. This is sometimes the easiest way to enter this trade. It's super easy. You just buy the longs, you sell the short, and you're done. You're in. And you navigate those spreads one at a time, and it's pretty easy. But the way I like to do it is I like to enter a spread first. So in this example, we are doing the 70-80 call ratio backspread. So we're -1 here, and we're +3 here. So what I can do is I can enter a 1-by-1 bear call spread. So again, I'm going to be short the $70 call and long the $80 call. That's called a bear call spread. I can go in and make this trade. So once I enter this bear call spread, I'm -1 of the 70s and I'm +1 of the 80s. And then what I do is I now go in and I buy additional calls. So what I'll go in is I'll just simply go buy 2 of the $80 calls. Again, just navigate that spread. And in the end, once I get filled on 2 calls, I am long 3 and short 1, which is exactly where we wanted to be. Long 3, short 1. So these are the ways that you can execute the trade. I have found that trying to enter this as an entire combo sometimes can get pretty hard. You put your order out there, it doesn't get filled, you sit on it for quite a while. I really like to either do leg by leg, or I like to just build a spread and then buy additional calls on it. That to me is the easiest way to get filled. And frankly, the easiest way to get filled is leg by leg. Leg by leg is definitely the easiest way to get filled. All right, so again, what I wanted to do before we jumped into Thinkorswim is go through, okay, we're going to build the trade. We're going to see where our break-even points are. I want you to be able to go in and calculate what is your risk on your expected drop in implied volatility, because that's what you're going to use to do your position sizing. So again, if you use $500 as your acceptable loss, and a 50% drop in volatility is a $250 loss, then you can do 2 of the ratios. So instead of doing a 3-by-1, you do a 6-by-2. We'll get into that here in just a second. But then when you go and actually enter the trade, pretty easy, use one of these methods and it's easier to enter the trade. All right, so I don't have time to go through this whole process because I really want to get into the logistics of the trade, but it's pretty easy. Look, you're just looking for a stock that's going to have a big move. Once you've been in the market for a while, if you're fairly new to the market, you're still not sure what stocks have big moves. Now, of course, everyone knows, actually not everyone knows, that Netflix is a big mover, that Amazon's a big mover. Actually, Amazon's not a big mover as much percentage-wise. We know that Tesla is a big mover. But outside of those big caps, sometimes it's hard to know what are going to be big movers. One of the things you can use is to scan for the highest implied volatility. Or you could just, again, if you're in the market quite a bit like I am, you just know what kind of stocks are going to do well. Now, I'm going to take a look at two trades here. I'm going to take a look at a stock called Tilray. Tilray is one of the first marijuana stocks to become public and traded on a public exchange. If you take a look at the charts on Tilray, you can see it came public at 20 and it's up to 50 within a month. So obviously we got some volatility. Here's a stock that's up 150% over a month and a half. So just by looking at a chart and looking at the percentage moves, you're going to be able to tell really quickly if something is a big mover. And if it's a big mover, it's going to have higher implied volatility, which means there's a higher likelihood of a big move. Now again, your job is going to be to determine, is the move going to be even bigger than the market thinks? Because the market is already going to price in an expected move. Now, if you have seen any of our other sessions on straddles, it's very easy to go in and see what the market is pricing in. You simply go to the at the money options. So really quickly here, this stock is at 50. So again, what we could do is we could go to this is the options chain, and we go to the 50. The 50 calls are basically, let's call it $8.20. The 50 puts are going for, let's call it $6.50. So add those together, that's $14.20 is the expected move. So if you do quick math, $14, and I'm just going to round it off. So if it's at $50, the expected move is it's going to go down to 36 or it's going to go up to 64. That's the expected move. So if you're going to do a straddle on this, it needs to go past that to make money. If you're doing a butterfly, then you're going to need to be between that to make money. All right. Again, just a really quick rundown of the expected move. But we don't want to do straddle because we think that this thing is more likely to go higher or lower. Now, of course, if we think it's going to go higher, we choose the call ratio backspread. If we think it's going to be lower, you choose the put ratio backspread. But it doesn't mean that we just go out and make the trade because we have to run our numbers. We have to know what is the move we need to see. So I'm going to look at this as a call ratio backspread. I know it's kind of crazy. It's gone from 20 to 50 already. But, you know, the market's strong here. This thing has been strong. If someone said I'm going to play a call ratio or a put ratio backspread on it, I would not disagree because it could easily go down as easily as it could go up. But I'm going to go ahead and build a call ratio backspread. Now, traditionally, what we do with these backspreads, again, we cover this in our main session, is we like to buy or sell deep in the money and buy slightly out of the money. So the current price of the stock is $52.78. So if I go all the way down and say, look, I want to sell the $40 call, and I want to go long the 55 call. Now what I did here, I'm holding down the control key because now I'm going to be building this as a combo. So as you can see here, I've built this as a combo down here, and all I do is I just simply go and change my numbers. Well, remember, I wanted to buy one. Sorry, I got to change this to custom. I wanted to sell one of the 40s, and I wanted to buy as many as I could in order to get a credit. Now, if you take a look at this little window right here, this actually really helps you. It tells me at 2 to 1, I am still on a credit, but if I go to 3 to 1, I'm now to debit. So that means that if it goes against me, I'm still going to lose money. But again, I get a much steeper line. But let's maintain a credit. That's usually what I like to do, is maintain a credit. So here is the trade. So if I go to my my risk profile, sorry, I've got this. All right. I've got to get all my settings back to normal. Hold on, everybody. All right, got to start over here. Okay, so we got to go out to expiration. All right, well, you know what? Let's not work on expiration. Let's just work on overtime, because really this is going to be really what we want here is overtime. This is the September. All right, so there we go. Okay, so again, this is our at expiration. So at expiration, our break-even points are right here at $39.95, so 40 bucks, and the upper break-even point is basically about 68. Again, I can always just drag my lines over it. It tells me where that is, 68.24 exactly. The worst case scenario is it closes at 55. That's where I'm going to take the most loss. If I come down here. Okay, so this is where, again, we get our percentages. It tells us that there's a 17% chance it closes below 40. And if it closes below 40, we make our credit of 170. There's only a 10% chance it closes above the upper point. So you can see here, this trade only has a 27% chance of being profitable. But if it really jumps up, you can see that the profit is going to be very, very nice. You're going to see I don't like this one because this one has huge implied volatility. The implied volatility, take a look at it, 134%. That's crazy. That's crazy volatility. So there's a lot of times where I like a setup, I like everything, and you know what? I realize that when I take a look at the trade on the risk graph, I just don't think it's going to move that much. So on this one, again, the implied volatility is really puffed up here. And you could take a look at this and say, you know what, I don't really love this one. Now, I wanted to show this one because I really want everyone to, if you're here at the live session, go and watch this tonight. Go and put this trade together. Now, what we really want to do is we're not going to hold it till expiration. We are going to hold it until right after the news announcement. Right after the news announcement. So again, we want to go to, you know, whatever tomorrow is. Right, we want to go down to tomorrow. This is tomorrow. Right, so this is what the trade is going to look like tomorrow, the day after options. Sorry, I got to go one more day. There we go. Okay, so this is the trade after options. However, what's not being calculated in here is a drop in volatility. So this formula here is not calculating a drop in volatility. Now it's telling us that after the earnings on Friday, it just needs to be above 65 or below, let's call it 38. Those are kind of our break-even points. And it tells us that our loss here, we're looking at about $400 of risk. That is actually not true because we need to assume that there's a drop in volatility. So what I'm going to go up here, I like to use this method here. Go up to volatility step. Right. So when we do this, we can actually ask for one line. So again, I've got plus one line. Now right now the step is at -15. Now remember, I talked about this trade here expires in September. So this is like three weeks, 3.5 weeks away. So we should probably expect about a 40% drop in implied volatility. So by doing that, we've now said, okay, show me what this trade looks like with a 40% drop in volatility. Now we're getting the real numbers of what the trade is potentially going to be like. We need to be above 67 on the break-evens. We need to be below 39. And you can see our risk here is actually closer to $600. So this would be the trade here with counting on a volatility crush. Now, if you want to be more conservative and you say, you know what, I think I want to be more conservative, that there's a 50%. And again, that's what I use. I use a 50% because I say, look, I'd rather be a little bit safer 50% is saying, okay, you're probably closer down here to $720 of risk. Now again, that's if the stock goes absolutely nowhere or stays at 55. Now these are the numbers. These are the numbers of the trade, and you can now decide, do I like this trade? Do I like this trade at all? Now I've decided I don't like this trade because I think the odds of it going up to 80 bucks are pretty slim, where I make about $1,000. I'm not too crazy about risking $720 to make $1,000, but the stock has to jump up 60%. I'm just not crazy about that. Sorry, it's not my cup of tea. So I'm going to go on to probably the next one I really want to take a look at, and that is Lululemon. Lululemon has earnings. Lululemon has earnings in 2 days. In 2 days. So if we take a look at the chart, you can see that we've got a nice uptrend. We got a nice jump here. Oops, we're still on Tilray. But Lulu's going to have a nice thing, and it's basing up here right around the 137, 138 area. So again, you could be looking at a put ratio backspread. That's totally fine. That's totally fine if someone said, Rob, I want to do a put ratio backspread. I totally agree with it. This thing could have a huge drop. And if you did a put ratio backspread, you'd make a lot of money potentially. But you could also say, I think it's going to have a big jump higher. It's been strong. Obviously, business is going well. Obviously, the economy is going well. This is retailer. If they announce really good numbers, they could jump. Now, the question is, where's the market expecting it to jump to? And can you look into the charts or find some reason why you think it's going to be more than that? So let's go back to building a trade on this. So Lululemon was at 138. So this is where now I have different choices. Now if I do the weeklies, that expire in 3 days, basically the day after they announce earnings, I need to expect that all the applied volatility is going to be gone. Now obviously that's going to bring us much closer to the overall max loss of the trade. Look, I used to do these kind of trades, and sometimes I hit it big. But these trades are what I call all or nothing trades. You will literally make a ton of money or you will lose everything you put into the trade. They're all or nothing trades. And I realize, wow, I don't really care for that. So I like to be at least 2.5 weeks out. So that would bring us to September 14th. That's 2.5 weeks out. The stock is currently at 138, let's call it. So again, I want to sell deep in the money, and I want to buy further out of the money. So I could take a look at doing the 130. So I'm going to look at selling the 130. And I could look at buying, let's call it the 145. All right, so let me cut down these spreads here a little bit. All right, so again, what I like to do, I like to set it to just a 1 ratio. I like to do this because it makes everything pretty easy. And since I didn't buy a combo, I'm going to have to do this by hand. I don't have my little window here, but again, I'm going to look at a 3-to-1. A 3-to-1 is going to give me a slight debit, meaning that I'm not going to have a positive return if it really goes down against me. Right, so here's the trade. Here's the trade on Lulu. Now I go into my risk graph, and now I say, okay, is this a trade that is acceptable to me? All right, look, okay, a loss of $10. Looks like this comes out pretty much as a wash. So if it goes against us, we're looking to basically make a 0. If it goes for us, where's our break even here? It looks like it's about 150. Let's call it 152.75. So this is where, okay, we have to go in to a chart. We have to go in and say, okay, well, do we expect that to happen? Remember, the stock right now is at 140. I'm just rounding. It's actually at 138. So we're asking a $12 move to the upside. It's at 138. Actually, let me do this correctly. It's at 138, so we're asking for a $14 move to the upside. So that's what the market is pricing in on this strategy. We need to have a $14 move, which is 10%, basically. $14 on a $140 stock. So you can take a look at this, say, okay, if this stock doesn't jump more than 10%, you're not going to make any money. You're going to take a loss. Now, if it tanks 10%, you're going to have a zero. You're going to be down here. You're going to be down here, and that's fine. That's fine. You take a small loss, a small gain. That's how this trade works. You're loading it all up to one side. So this is where you have to go in, look at your analysis, and say, okay, do I think that it's going to be a bigger than 10% gain? Do I think it's going to move more than a 152.75? However, this is all without the volatility crush. And that's where people get this wrong, is they look at this and they say, oh, and then when they make the trade, they find out, oh, wait, I really needed to get to 156, and my actual risk wasn't $1,400, it was $2,000, because they don't count on the drop in volatility. Oh, wait a second. Look at this. I'm already at a drop in volatility. Sorry, everybody. I forgot to change it back. So let's go to the regular trade. All right. With no drop in volatility, these are the numbers. With no drop in volatility, and again, holding it until the day after earnings, which would be the 31st. All right. So here we have the break even here is more around 150. Yeah, 150 is the break even. And of course down here we got to get down to the 123s if we wanted to exit the day after earnings. So again, earnings come out, we want to exit. So it looks like the risk here is like $600. Now again, but this is not with a volatility crush. So if you looked at these numbers and you didn't calculate in a volatility crush, your numbers are incorrect because you're not calculating it correctly. So let me go ahead and add a 40%. Again, we're 2.5 weeks out. Our numbers change here, and they look more like we saw the first time. So again, you got to get a 10% move this way to be profitable, and it looks like your risk here is $1,300. All right, now that is the trade, and if you can't risk $1,300, guess what? You cannot make this trade. There's been a lot of times where I've put in all this work, gone in and seen, oh wait, I can't even do one contract of this. This is where having bigger amounts of capital definitely helps. You can take more of these trades. You're not priced out just due to position sizing constraints. So this is the trade, and hopefully everyone has seen this is how you go in and you build this trade. This is how you get all your numbers. Go ahead and plan on that volatility crush, and then look at the final numbers and say, okay, is this a trade that I do want to take? And if the answer is yes, I think 153, I think it does go past 153, and I think it could substantially go higher, potentially all the way up to, 170. Now this trade makes sense. Remember on that Tilray trade we looked at, 170 is going to look at about like a $3,400 gain. So all of a sudden now, if we're looking at a 20% move, if this goes up 20%, we're risking basically $1,300 to make $3,400. I'll take that bet. I'll take that bet anytime. What I won't take is the other bet we saw in Tilray, that it had to go up 50%. I think it was $600 to make like $900. That was not appealing to me. Remember, this strategy is I think there's going to be a huge move. I want to be aggressively going after it, but I also want to be careful about my risk. Again, this is the strategy here. All right, so let's go back to a couple things we talked about. Volatility crush, because this is the biggest thing I wanted you to be able to really take a look at this strategy. And this, frankly, is our theme for this month of sessions, is volatility. I don't know if you've noticed, but we've been having some themes this year. Every month we have a different theme of what we go through. And this month has been all about volatility. So I really want to highlight this. Your volatility crush is based on how much time is left in the option. And as I said earlier when we went through this, I wish I could give you hard, fast numbers, but I can't, because it changes. Every single one is different, and implied volatility is you can't measure it. It's not a linear mathematical equation. It's people's emotions. It's people's reactions and behaviors. But I gave you these rule of thumbs. If your option expires in the short term, a couple days, just expect to lose almost all of the 40%. If it expires in, I'd say 1 to 2 weeks out, I like to use 50%. Now in this example, we were about 2.5 months out. 2.5 months out, so I use 40%. So again, it's going to be on a sliding scale. I just gave you these points, but just look, if you're 4 weeks out, maybe you do 37%. Again, it's going to be a sliding scale, but I think you should at least expect a 30% drawdown. At the worst, even if you're really far out, I still think you expect 30%. And if you're really short term, if you're doing this 1 day out, you better be at 100. You better be at 100. So just be somewhere in that range of that scale. All right, again, my advice to everybody is, if you're new to this strategy, go onto your demo account. Make the Tilray trade. Go ahead and build that trade. Go ahead and make it. Go ahead and make sure you write down all your numbers of, okay, this is what I think the risk is going to be. This is what I think my break-even is going to be. And then see what happens. And what I want you to do is see what happens. Okay, how much did volatility actually drop? I thought it was going to drop 50%, and it really only dropped 30%. Once you go through these a couple times, you're going to get a good call and range for what to expect in the volatility crush. So again, if you're watching this on the video, I recommend go find some stocks that have news coming up and go build these trades in demo trades. Build them, again, put all your numbers down, put down how much you thought this trade would lose, and then take a look the next day after earnings, how much did it lose if it didn't go anywhere. Say, okay, I calculated if it didn't go anywhere, I'd lose $400, but in my demo account, I'm down $700. Why? My guess is volatility dropped more than you expected. So again, this is what the whole exercise is about. Go through this, and a couple times you're going to get, like me, a good idea of, okay, I expect this to have a 42% drop in volatility. I expect this to only be a 35% drop in volatility, just because I've seen it over and over and over again. But use this little scale in front of you as just a little measure to take care of it. All right. Do we have any questions? Please go ahead and ask them. Like I said, this is more about kind of looking at the numbers, building it, looking at the numbers, making adjustments for the volatility crush, and then really everything else comes down to charting. It comes down to charting, and do you think it's going to have that large of a move? And if it does have that large of a move, how much do you stand to make? If it doesn't have that move, how much do you stand to lose? And then it comes down to, do I want to make that bet? Do I want to risk, $400 on the chance to make $1,500? Well, the odds are pretty low that you're going to make that $1,500, but you think, based on your charts and your experience, that there's a better chance than the market is pricing in. Because remember, the market is pricing in, again, I don't want to call it the perfect amount because it's not perfect on this trade. But the market is pricing in the perfect amount over thousands and thousands of trades. If you take this trade 1,000 times on 1,000 different stocks with 1,000 different numbers of implied volatility and volatility crushes, you should break even, but you will be down because of spreads and commissions. That's how options pricing works. So when I say it's the perfect pricing, it doesn't mean it's perfect for this trade. It's not going to be anything close to it, most likely. But over thousands of trades, it is the perfect pricing for this. So again, you're betting that, hey, on this one, it's underpriced, and it's actually going to go more than the market expects. All right, hey, thank you so much for joining me. That was fun. It's, again, this strategy, when I found it, I loved it, and I used it over and over and over again, and it was during a time of stocks that were being very highly rewarded or very highly punished when they beat or missed earnings. And I thought to myself, oh my gosh, I found it. I found the holy grail. All I have to do is, when a company announces earnings, put on a call or put ratio backspread, and yes, I'll lose a couple times here or there, but on this one I'll make a big gain, and over the net I'll be really nice. And I did it during a period of above average volatility. And so what happened? Oh, this strategy delivered better results because it is a long volatility strategy. But then what happened was volatility contracted. I kept clicking the buttons, and most of my ratio back spreads didn't work, and even the ones that worked didn't work enough to offset my losses. Ended up having losses on this strategy during that period. And I also thought, dang it, I thought I had found the Holy Grail again. Look, I am no longer looking for the Holy Grail of trading. I am no longer of the opinion that there is one strategy that you can do for the rest of your life that's going to produce gains. You need to be a trader. You just need to be a trader. That doesn't mean you just sell condors on the S&P for the rest of your life, because you're going to get blown up doing that at some point. Develop different strategies, develop ways to know when to use different strategies, and then you can actually be profitable on the long term. This is just one of those tools in the arsenal that you pull out every now and then when the market is telling you it's time. All right, thanks for joining me, everyone. Happy trading. Goodbye.